Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and an update to one of my favorite investments, real estate and REIT stocks. Nation, nobody could have seen 2020 coming, but the mark of a great investor is being able to read the signs, being receptive to the clues in the market, and using that to be ahead of the next trend. And while real estate largely does seem to have escaped the pain that we saw in a lot of the other sectors of the market, there are some early warning signs that a large-scale real estate reset is just getting started. In this video, we'll look at how the different property types have done this year and the trends pointing to how you should be investing in real estate for 2021. We'll look at investing in real estate investment trusts, those REITs that trade like stocks, as well as the private market and real estate crowdfunding, where frankly, I think you can get better deals and higher returns. Let's get started, but I gotta send a shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, one of the biggest themes we've been talking about this year is the splitting of the real estate market, with some property types doing really well and others not so much. This table by the National Association of REITs does a great job of showing you why you can't just think of the real estate market as one investment. You really do need to be thinking about these different property types and the ones that can do well. I've highlighted the year-to-date returns in red, and you see that overall, the market for real estate has been hit really hard with the equity REITs and the NAREIT index, so those companies that own real estate property, these have fallen by 17.5% through the third quarter. But it is a completely different picture if you look at it by property type. Three of the types here, lodging, retail, and office space, account for the majority of the losses, with stocks in these segments falling between 30 and 50%. And of course, it's not hard to see why. Business travel has all but died out, and there's no more in-person conferences to fill those hotels. The massive shift to online shopping has just meant empty malls, and work from home means less office space is needed. Look at a few of these other segments though, and you realize that there's still money to be made. You've got the self-storage market eking out a 5.8% return. Industrial property is beating the overall market with a 9% return, and data centers are booming for a 25% return on the year. And with these as well, it's an intuitive story. Industrial property includes all those warehouses and the logistics centers that are just being used in that shift to e-commerce. Infrastructure REITs are those building out the cell towers for 5G, and that's not slowing down for a second. The data centers, so all the internet traffic means more servers and more data centers. But that's all in the past. What are the trends for real estate heading into 2021? Are the underperformers this year just dead money, or is there a chance for a rebound? So I want to look at three major trends, what it could mean for real estate investors, and how to position ahead of this market. We'll look at the trend to work from home and the shift to ex-urban office space. I'll explain how the mortgage and foreclosure moratorium might mean selling isn't over in the residential market, and then some disturbing clues to why you might not want to jump into that rebound in retail. REITs in the office space have fallen 30% this year as that shift to remote work boomed in the lockdown. Telecommuting was already on a multi-decade uptrend, hitting 50% to begin the year from less than 10% in 1995. But it's absolutely exploded this year, with as much as 63% of the workforce reporting working from home during that quarantine. Of course, that number has come down since April, but as someone that has worked from home for 7 years now, I can tell you that we will always need some office space. Even without coworkers or a boss, I rent space at a local co-working site, and some businesses just can't get anything done when you're working totally remote. Elliot Benkuya, co-founder of investing platform Streetwise, told Forbes in August, "There are disadvantages to a fully remote lifestyle. Teams and conversations are siloed to those invited to a call, and knowledge transfer is limited. Personal relationships don't happen, and often advancement opportunities just get missed." Benkuya sees the solution as a hybrid, where some people work remotely for parts of the week and then in the office for 1 or 2 days. Workers will still need to be close to the office for those last-minute meetings, and total lease space is going to be smaller because not everyone is going to need to be in the office at the same time. Now that means office space is going to be needed where the workers live, outside those expensive urban centers and into the suburban areas. And to this point, we're already seeing a boom in sublease inventory in the city centers as those tenants try to fill their previously used space instead of breaking their lease. Office space for sublease has jumped 20% in Los Angeles, and as much as a quarter of Manhattan's available space is up for sublease. So as that shift in demand happens from the city centers into the suburbs, you're going to start seeing that split even within the office market. Vacancies could rise and rents fall in the urban centers as the secondary markets see better fundamentals. Now, since most office-focused REITs are concentrated in those urban markets or spread across both, I'm mostly investing right now in the private markets and crowdfunding REITs for office space. With projects like on Streetwise, you can follow a portfolio just closer and make sure that their investing strategy aligns with your own outlook. For example, the Streetwise properties are located in secondary non-gateway markets just outside of St. Louis and Indianapolis and have been able to keep high-quality tenants. Now, this next property type, residential, is really interesting here because while home prices are up double digits since last year, REITs owning residential property are down 20%, and this might actually be the next shoe to drop. The reason why REITs like Equity Residential and Camden Property are down so much is because of those rent moratorium programs, allowing some tenants to forego rent payments for as much as 6 months now. And while the moratorium on those evictions and foreclosures has been necessary during the lockdowns, the bill always comes due. And granted, some kind of nationwide rent assistance might lessen the effects here, but according to the Eviction Defense Project, up to 20% of the nation's 110 million renters are at risk of eviction. And this isn't even counting the millions of homeowners that have fallen behind under that mortgage forbearance. Nation, we can only kick that can down the road so far. And within the first months of 2021, we could see a wave of evictions and foreclosures as people just decide it's not worth it to pay up 6 months of back rent or payments. Now, housing prices have been really strong this year, with most markets up double digits from 2019, but a lot of that is just on historically low supply of homes for sale. Homeowners just aren't putting their homes up for sale, which means higher demand and higher prices. But you get those evictions and the foreclosures hitting the market, and you're going to see prices come down. Then homeowners that have thought about moving are going to be rushing in to list their homes before the prices fall any further, and you get that 1-2 punch that could cause the housing market to crash. So I would actually avoid residential REITs in favor of the healthcare and maybe industrial, but if you're going to be investing here, focus on those with most of their portfolio in the suburban markets outside of those city centers. The retail space, especially those shopping mall REITs like Simon Property and Macerich, have just been slammed this year, down a whopping 39%. And now, while we will see some kind of a recovery on a vaccine and maybe even some stimulus, I think the long term here is still going to be very difficult for this market, and doubly so for the malls. The graph here by the Federal Reserve shows e-commerce as a percentage of total retail sales, and we see that long, steady climb over the past 2 decades. But just look at this huge jump this year, from 12.5% to 15% in total retail purchases. And now a bump of 2.5% might not seem like that much, but just look at the profitability measures for retailers like Kohl's, ticker KSS here. The operating margin, now that's the percentage of sales left over after paying suppliers and all operating costs, that's just 1.4% profit and doesn't include paying interest on debt or taxes. The entire retail space is like this, with those razor-thin margins and no room to lose another 2.5% of purchases to online shopping. And the shift is only going to get worse now that millions have been forced to go online to get their groceries and shopping and seeing how easy it is. That's the downside in retail, but it's even worse in the mall owners where they've taken on tens of billions of dollars in debt just to survive, and they're now converting a lot of their space into that much less profitable industrial centers like Amazon fulfillment. So if you are going to play the rebound here in this market, you want to be in those high quality properties, maybe like a Macerich instead of an SPG. I still think you can own some shares of Realty Income since it has a lot of its properties in that convenience and consumer staple retail side of the market. But you just need to be really cautious here on that long term, especially on these retail real estate and REITs. Check out the Streetwise portfolio with the link in the description below and click on the video to the right for my favorite REIT stocks to buy. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.